Oh, that's real good.
Hello everyone, and welcome to our channel Penny Lesson. We talk about everything finance, from tips on making money and proper investing to news about the different economies and situations affecting the global markets. The goal of this channel is not only to teach you how to be more financially responsible but also to teach you how to be more aware of global events. So why not just sit back and relax while we tell you what's happening in the finance sphere? Be sure to subscribe to my channel and hit the notification bell to be constantly updated on my latest videos. Remember, one penny lesson a day keeps being penny less away. Raoul Pal, author, CEO, and co-founder, explains the ongoing market crash and the recession. With the economic conditions the way it is now, how much worse could it be for the future? In this video, we will have Raoul Pal tell his insight into the current state of events through his perspective. I believe that the point at which growth implodes is extremely near. We start to notice things in on-chain analytics that only ever occur during these significant bear market sell-offs. The declines of 2014, the 2017 sell-off, and similar things. Additionally, we are oversold by 2 standard deviations near the bottom of the logarithmic trend channel. The 5-year exponential moving average is where we are. About the finest risk-reward ratio that has ever been found has been found at that level. The RSI is oversold, just as it was at the bottom of every previous cycle. Everyone believes that inflation will remain at 20% forever at the moment when the macro narrative is at its height. Any rate of change indicates a risk-reward ratio that ranges from 20 to 50 times. Where you are on the risk curve now determines what to do. Contrary to my working premise, I still don't believe the equities markets will hit any meaningful new lows. Because of the unmatched sentiment in the stock market, they may breach the low, move a little lower, and then break back higher. I'm about to write the worst sentiment in any metric of any survey in the history of equities markets and global macro investor. People are therefore noted as being bearish because they are scared of what is happening. The bond market is out of control, which sets the price for everything. It is a frightening situation, but from my perspective, 2 games are being played. One is being played by the Volcker Wantobes, who have had their moment in the spotlight, while the other is being played by a much more powerful group, politicians. Politicians are the ones who decide on policies. Politicians will alter the rules once they determine that economic growth has reached an unsustainable level. To ease the suffering, quantitative easing offers direct handouts and other measures. Mortgage rates like these can't last for very long until unemployment sets in, and this becomes a significant issue for the administration. There is a tendency for the market to start pricing in that someone will need to intervene shortly. Since the struggle they remember was the one for which the brave hero Paul Volcker fought, I believe that the Fed has caused this by taking up the wrong fight. It will begin someplace and expand, but this can't last forever. Politics is nothing more than a storytelling game. So, where does the story stand? The narrative takes you down the most painful path before putting you in a position to employ optimism. They will therefore concentrate on the most painful way because that is what garners support. Human psychology holds that fear, resentment, and fury tend to get you more votes. Therefore, if unemployment starts to increase, they will start to change course and declare that growth is now the enemy rather than inflation. The new narrative adjustment is audible and simple to implement. All of it is narrative. If this trend continues over the next few weeks and oil trades in the direction I've been predicting, the Fed will have a break-even inflation rate down to the 2s. These break-even rates will eventually drop to 1%. The conflict is so over. In 18 months, I anticipate negative inflation. They seem to have utterly misinterpreted the bullwhip, which stated that the post-pandemic inflation rise was caused by everyone entering the labor force. No supplier reacted excessively to supply. Yes, they should have hiked rates, but not in this manner. They misunderstood the situation because they wanted to emulate Volcker, and before they knew it, they had devastated the economy, brought on inflation, and caused deflation. Looking at the Nasdaq, which is now down 30%, I wonder what more people could want. Yes, they want a 50% drop because they want blood. Do they receive 50%? If we return to the Volcker era, when everyone so adored the market was down 27%, I doubt it. When World War II ended in the 1940s, the market fell by 22%. The ISM rate dropped to 30% in 1990. What caused a 20% drop in the stock market? Everyone is persuaded to persuade themselves to be bearish. The US owes about 300% of its GDP in terms of total debt to GDP. Everyone borrows money, and since the Fed is governed by a group of baby boomers, everyone is attempting to act like Paul Volcker to get a book published with them on the front cover as the heroes. So it's challenging to produce inflation when the population is aging, and there is a lot of debt. However, the Fed is now determined that they must emulate Paul Volcker, and as a result, they will hike rates above what the market can bear. We are unable to manage these rates and the sudden liquidity. Therefore, the effects of quantitative tightening have reduced liquidity. Money has been kept out of the market because of what it did to the banks and the requirements for holding bank reserves. The bond market has the same level of liquidity as it did at the height of the pandemic because there is no buyer. The current state of the bond market is dire. It is independent of anything. Bond market volatility is another way to look at it. The bond market's volatility is higher than that of the stock market. Again, we're approaching the absolute crisis height when the entire world shut down and we believed everyone was going to perish. This is not normal. That demonstrates how dire the bond market situation is. That has caused the bond market to become independent of the underlying inflation narrative. Because the Fed has stated that it will do whatever it takes to prevent inflation, this is not truly a fear of inflation. What has happened is that the break-even rate has concurred with that and declared that inflation is not the enemy. Break-even inflation for 5 years was 2.4%, which broke down today, and for 1 year, it was 1.95%. They are, therefore, essentially 2%. The market, therefore, claims that future inflation is returning to normal. Okay, but the issue is that real rates have been drifting lower over time even though bond sales are increasing and inflation expectations are decreasing. Due to demographic changes and debt, they tend to be lower. Thus, you need low real rates to either boost the economy or keep it functioning regularly. Therefore, real rates have a negative 1% trend rate. However, the recent increase in real rates was the fastest ever. Because there is too much debt in the world, you are increasing real rates on people at a time when they cannot afford to pay their loans. In other words, the Fed has overstepped its bounds with this entire mechanism involving how the banks can utilize their balance sheets plus quantitative tightening plus raising the Fed funds rate, and the market is freaking out as a result. The bond market, the ISM, and the bond market are therefore typically connected at the hip because it is detached from the fundamentals as well. Bond deals decline when the economy grows less because, yes, both inflation and growth decline. What has happened is that bonds are priced using an ISM that is currently in the high 60s when the ISM will cross 50 in the next month. The recession, which we all know is occurring and has been confirmed by nearly every guest we've had, will thus be cited by the ISM, even though the bond market is dysfunctional. Although there have been a few similar occurrences, this is the furthest the bond market has ever been from the business cycle. It alerts you to the fact that a significant dislocation is taking place. The currency market is affected by this disruption as well. You are already aware of the dollar and yen. Because there was yield curve control and you were printing in, there was a unique circumstance. The currency crashes as a result of the UK rising rates while cutting taxes. Additionally, the value of the pound fell by 3.5% today. This currency ranks in the top 5 in terms of market value and is more volatile than the Nasdaq. This is extraordinary, but it's not only because the same issues exist throughout the Eurozone. South Korea is in disarray. What we are dealing with is a global dollar shortage. Now, that also exports a significant amount of deflation. China, one of the world's top exporters of complete goods, is among the most affected countries. South Korea, Germany, and Japan-Taiwan, all of them are seeing sharp currency drops. The U.S. thus somewhat approves of it. Additionally, it benefits them geopolitically since it allows them to exercise their power, the U.S. dollar being their greatest source of influence. 87% of international traders use U.S. dollars. Despite the U.S. contributing 25% of the global GDP, the system as a whole is being choked. Asia as a whole has no dollar liquidity, and that's a difficulty. There is a structural issue here, not merely a current cyclical one. As a result, the changes we're witnessing in the bond market and currency markets are starting to feel quite unprecedented. The unheard of kind of thing we witnessed in March 2020. Mortgage rates are still rising sharply as a result of this. Since it is not a money issue, it has a genuine impact. This is a real issue that is getting worse for the populace. Rents and prices for housing are already declining, as are housing purchases. The housing industry, which employs many typical Americans and is a significant employer in Europe, will begin to see unemployment. There you have it. Quite possibly the largest economic crisis in history. What do you think of Raoul Pal's sentiments? Do you agree? Let me know your thoughts in the comments below. Wow, was that news? Why not ponder it? Want to know the latest? Comment if you want more articles like this. This video is just one of many videos on my channel that brings you the latest news about the world of global finance and economics. So go hit that subscribe button if you don't miss out on content like these. If you enjoyed this video, please hit the like button. Thank you for all your support, and I'll see you again next time. Remember, 1 penny lesson a day keeps being penny less away. Cheers.